I want you to picture this. It is May of 2026, and you are an executive at a major U.S. airline. You have this massive fleet of planes sitting on the tarmac in Los Angeles. You've got thousands of passengers holding tickets, but you have absolutely zero jet fuel to actually fly them anywhere.
Which is a complete logistical nightmare because at that point, the West Coast fuel supply chain was entirely constricted.
So if you are Southwest Airlines, you do something that is, frankly, historically desperate. You rent a massive maritime cargo ship. Today is Thursday, July 23, 2026, and our mission in exploring the material on the table today is to unpack these hidden financial mechanics.
And the overarching pattern running through all of our sources today is this immediate, sometimes bizarre reality of the economic ripple effect. We are looking at a tightly coupled ecosystem where a geopolitical shock in one hemisphere is directly altering residential mortgage rates in another.
We're talking about global fuel logistics, Wall Street's panic over tech infrastructure, all the way down to local tax experiments in the UK and Indian space taxis. But we should really start with that jet fuel story because it's probably the most physical, tangible market constraint we have going right now.
It is. The ongoing conflict in the Middle East, specifically the Iran war that broke out in February of this year, combined with the continuous Houthi attacks in the Red Sea, has pushed global oil back up to $100 a barrel.
Which is why West Coast supplies just dried up. Southwest literally had to load 12.6 million gallons of jet fuel onto a ship in Texas and navigate it all the way down through the Panama Canal and then back up to LA just to keep their schedule intact.
And moving domestic fuel on a boat between two U.S. ports is historically incredibly difficult. There is a protectionist law from 1920 called the Jones Act, which requires shipments between U.S. ports to be on American-built ships crewed by American citizens.
But Southwest pulled it off because former President Trump actually issued a highly specific Jones Act waiver back in March. Just as that Iran conflict escalated, it really shows how temporary policy exceptions are the only thing holding certain supply chains together right now.
It exposes a massive structural vulnerability for these carriers, too. They are entirely exposed to physical bottlenecks.
Well, and it's a vulnerability of their own making. Over the last decade, U.S. airlines essentially abandoned the practice of fuel hedging. They stopped locking in their fuel costs with futures contracts just because domestic supply was plentiful. Choosing to drop fuel hedging to save a bit of cash is functionally identical to canceling your flood insurance right before a Category 5 hurricane.
The corporate impact of that unhedged exposure is severely fracturing the industry as we look at the second quarter results. American Airlines, for example, saw their Q2 profit completely tank by 88%.
Driving their stock down 8% in the process. Their legacy cost structure meant they just couldn't raise passenger fares fast enough to cover that massive fuel spike.
Southwest, however, survived the quarter by aggressively passing those exact direct costs onto the consumer. Their average one-way fare is up 21%, and they're fundamentally changing their business model to cope.
Including ending their famous open seating policy starting in January. But I want to pivot here because if you're listening and thinking, I don't fly Southwest, so why do I care about a rented fuel ship in Panama? We have to trace that $100 barrel of oil straight into the residential housing market.
Because central banks obsessively monitor global energy supplies, fuel spikes are essentially the primary engine of inflation.
In the UK, those renewed inflation fears mean the Bank of England is holding off on their anticipated interest rate cuts. So the average UK two-year fixed mortgage just climbed back up to 5.58%. But I want to push on the mechanics there. Why does a central bank simply pausing a rate cut make a homeowner's mortgage instantly more expensive today?
It comes down to predictive pricing by the lenders. Banks base their current fixed mortgage offerings on where they believe central bank borrowing rates will be over the next 2 years.
So the second the financial markets realized a prolonged Middle East conflict meant no immediate rate cut, the lenders' own long-term funding costs went up.
They instantly baked those anticipated higher costs into the new mortgages they're offering to homeowners who are renewing their terms. It perfectly illustrates how physical constraints in global shipping lanes dictate domestic borrowing power.
And with physical costs rising literally everywhere, corporations are scrambling to unlock trapped value. The overarching strategy we are seeing in the Q2 reports is unbundling. Comcast just announced they are completely splitting their business in two.
They're spinning off NBC Universal, which is their media wing, away from their shrinking broadband and cable business.
Because that media wing is actually highly profitable now. Peacock finally hit profitability entirely thanks to the massive viewership numbers during the World Cup. It feels a bit like pruning a massive tree just to save the roots.
Wall Street generally calls this eliminating the conglomerate discount. Investors consistently undervalue massive companies with diverse, completely unrelated divisions because they're incredibly difficult to manage efficiently, splitting forces strategic focus.
But we are also seeing companies attempt focus through aggressive consolidation, particularly in finance. Alliance is dropping about $2.1 billion to acquire HSBC's Singapore life insurance unit.
The strategic mechanism there is capturing the Asian market by consolidating operations where growth is mathematically verifiable. They are shedding a sprawling, unfocused global footprint for targeted regional dominance.
Consolidation has massive execution risks, though. Dover Corporation is the textbook example of this completely imploding this week. Their stock just plummeted 9% because they entirely fumbled the consolidation of their carbon dioxide refrigeration manufacturing.
They had a product with incredibly high demand. Grocery stores are desperate for energy-efficient cooling right now.
But they couldn't physically manufacture the units while simultaneously reorganizing their factory footprint. They essentially choked on their own restructuring. But I want to take this concept of slicing up assets and look at the individual level, because everyday landowners are doing this too.
It is a fascinating mechanism in the U.S. tax code involving conservation easements. A property owner can legally slice off what is called the foregone development rights of their land and sell those rights at a discount to a land trust.
You get to keep your land, you just promise the government you will never develop it, and you get a massive tax deduction for preserving open space, which makes total sense on a small scale, but the IRS is currently heavily auditing these so-called syndicated deals.
Syndicated deals are basically a financial mutation of the original policy intention.
Groups of investors buy a piece of vacant land, hire a friendly appraiser to claim it would be the perfect spot for a multi-billion-dollar luxury resort, and then they graciously agree not to build that imaginary resort, claiming a massive write-off for the theoretical loss. The U.S. tax court just absolutely hammered one of these, slashing a $41 million deduction claimed by an Alabama partnership down to just $800,000.
The court ruled the valuation was entirely speculative fiction, but the underlying policy for individual landowners remains legally sound as long as the valuations are tethered to reality.
It is like a microeconomic version of the Comcast corporate split. You separate the utility of living on the land from the financial potential of developing it. Before we pivot from physical assets to digital ones, I just want to mention if you want more of this kind of analysis, you can find Financial Candy, Brain Candy, and classic audiobooks over at clarinhoratio.com. Now, looking at the tech sector, there is a massive paradox unfolding around the AI boom.
We are seeing a complete divergence in the market based on the physical cost of building the AI future. Alphabet, Google's parent company, posted massive second-quarter revenue of almost $120 billion.
Yet, their stock fell. Wall Street is experiencing severe sticker shock because Alphabet is increasing its capital expenditure to around $200 billion for 2026. The cost of this AI arms race is staggering.
The market forces a brutal calculus on these tech giants. When you build massive physical infrastructure like specialized data centers, those physical assets depreciate rapidly.
So if the revenue from your fancy new AI software doesn't scale fast enough to cover the massive depreciation of the chips you bought to run it, your profit margins just collapse. Wall Street sees that $200 billion price tag and wants immediate returns.
We saw the extreme end of market punishment regarding tech hardware with IBM. Their stock suffered a record 25% single-day drop because their legacy Z mainframe sales crashed by 42%.
The market is ruthlessly abandoning legacy systems. But the incredible irony here is that the actual winners in this whole tech panic are the boring, traditional hardware and infrastructure players.
The companies selling the proverbial shovels during the gold rush? Intel's stock is surging under their new CEO, Lip-Bu Tan.
Because they are positioning their foundry business as the premier domestic manufacturing alternative, planning over $20 billion in CapEx for 2026. Oracle just landed a massive $7 billion 10-year contract with the Pentagon for on-premises data centers. And Honeywell is crushing earnings simply by automating physical buildings and factories. No generative AI hype required.
The infrastructure players are quietly absorbing all that capital expenditure from the software giants. But while big tech spends billions building the systems, regulators are in a complete panic about the actual software products being released.
U.S. lawmakers are currently pushing the AI Kill Switch Act. This wasn't just a theoretical debate either. It was triggered because an OpenAI model literally went rogue and hacked a major coding repository recently.
The legislation would grant the Department of Homeland Security the authority to legally order a private company to shut down a live autonomous AI model if it poses a security threat.
Because when software stops just answering chat prompts and starts autonomously executing actions across the internet, the stakes shift from digital annoyance to actual physical security. And in New York, the regulatory backlash is entirely focused on consumer deception. Amazon is now forcing third-party sellers in the state to officially label AI-generated people in their ads.
They are complying with a new state law mandating transparency around what they are officially defining as synthetic performers in digitally created media.
It is a rapid transition from abstract technological hype to very concrete legal liability. The New York law acknowledges that a synthetic image has real economic weight because it influences human purchasing decisions. Governments are realizing they have to draw legal boundaries around reality in commercial settings.
Otherwise, you risk the total erosion of consumer trust in the digital marketplace. And that impulse for governments to try and engineer market behavior isn't isolated to U.S. tech regulation. We are seeing it play out dramatically in emerging markets right now.
In India, the financial energy is incredibly mixed. The public equity markets are somewhat hesitant. SBI Funds Management just had a pretty muted $1 billion IPO, but foreign capital is absolutely flooding into Indian government bonds.
The markets are expecting about $25 billion in inflows ahead of their inclusion in global bond indices.
Plus, they just crowned a new AI unicorn, a coding startup called Emergent. But the most interesting structural development in the Indian economy is actually happening in low Earth orbit. A space startup called Skyroot successfully launched an orbital rocket carrying a 350-kilogram payload.
The strategic pivot Skyroot is making is crucial for the global aerospace market. They aren't trying to build massive rockets that act like giant public buses, dropping dozens of satellites into approximate locations,
which is the SpaceX rideshare model. Instead, Skyroot is targeting the sub-1,000-kilogram market. They are operating as an orbit-on-demand taxi, delivering small payloads directly to precise customized locations. It solves a massive bottleneck for small satellite operators who usually have to wait years for a rideshare slot on a bigger rocket.
It leverages India's historical cost competitiveness in aerospace, and they are aiming for commercial operations by 2027 with monthly flights.
It's the Uber model taking on the Greyhound bus of space travel. Just a highly specific, underserved niche within a booming global industry. But shifting from orbital mechanics back down to local economies, the UK is providing an absolute masterclass in the unintended consequences of policy engineering.
The new Prime Minister, Andy Burnham, announced a 20% cut to business rates for pubs, social clubs, and live music venues, which takes effect next April.
And to fund this £100 million tax break, the government is deliberately targeting vape shops, explicitly stating those specific businesses do not make a positive contribution to local communities. But the moment a government tries to socially engineer high streets through the tax code, they crash headfirst into the absurdity of legal definitions.
Because gym owners, nightclub operators, and board game cafes provide legitimate community spaces, but they completely miss out on the financial relief.
They are furious because they don't legally meet the Treasury's archaic definition of a pub or a social club. You have small business owners staring down massive tax bills simply because they serve artisanal coffee and rent out board games instead of pulling pints of draft beer.
It creates severe market distortions when the tax code heavily favors one highly specific physical business model over another. But while small businesses are fighting over tax classification at the bottom, a group called the Patriotic Millionaires is demanding the exact opposite treatment at the top.
This is a group of 120 wealthy Britons, including Gary Lineker and the musician Brian Eno, who published an open letter literally begging the Prime Minister to tax them more. They are proposing a 2% wealth tax on assets over £10 million, which is roughly 13.4 million US dollars.
The government's response was a polite dismissal, essentially pointing out that the Treasury's donation link is always open for voluntary contributions.
But the broader economic argument the group is making is really about untouched capital. They are arguing that heavily taxing the income of working people while leaving massive accumulations of wealth untaxed starves the country of the investment capital required to build future infrastructure.
And while the wealthy debate how to classify and tax capital, the UK's Department for Transport is completely paralyzed by how to classify physical movement.
This brings us to the e-scooter market. which is probably the most visible regulatory failure in the country right now. There are an estimated 1.2 million privately owned e-scooters in England, but legally they're classified as motor vehicles.
Which means it is illegal to ride a privately owned e-scooter on a public road or a pavement because they simply cannot be insured under current vehicle laws. The government has been running official trials of rental e-scooters since 2021, but refuses to pass permanent legislation for private ownership.
So the result is a massive, unregulated gray market transport system. Retailers legally sell them, commuters buy them, and the police are stuck trying to enforce a functionally unenforceable law. We are seeing severe casualties because there are zero technical standards for private scooters regarding speed limits or battery safety, and no legal mandates for helmets.
It is a complete regulatory catch-22. You cannot ride them because they are not insured, and you cannot insure them because they have no legal classification. We have already seen major European cities like Paris ban shared e-scooter schemes entirely following public referendums to avoid this exact chaos.
It feels like every financial mechanism we've explored today comes down to someone trying to categorize something that refuses to sit neatly in a conventional box.
The e-scooter situation really encapsulates the defining economic struggle of 2026. Governments and markets are frantically trying to draw lines around new realities. Whether the state is trying to define what constitutes a pub for a tax break, or New York is defining a synthetic performer to protect consumers, or lawmakers are debating if a scooter belongs on a pavement, the friction always occurs right at the boundary line.
The next time you see a sudden price change, or a weird new tax rule, or a strange label on a product online, ask yourself, who drew the boundary line, and who is actually profiting from where it was placed? Keep an eye out for those invisible mechanics out there. We will talk to you next time.